Good morning. I'm Vanda Vickers. I'm the Chief Operating Officer at the Global Risk Institute, and I'm delighted to welcome you to today's webinar, 2024 Housing Market Outlook, Demand, Supply, and Price Variability with Robert Kapsik. Although this event is virtual and many of you are joining us from across Canada and beyond, I wanted to take a moment to acknowledge that the Global Risk Institute is situated on the traditional territory of many nations, is covered by Treaty 13 with the Mississaugas of the Credit, and is now home to many diverse First Nations, Inuit, and Métis people. Through this land acknowledgement, we want to bring context to the history of our country and the importance of working towards reconciliation in all the ways we can. Before we begin, I'd like to review a few housekeeping details. Please note that this session is being recorded and will be shared on our website shortly. Your microphones have been muted to avoid background noise, and we've allocated ample time for questions during the Q&A section at the end of the event. Please submit your questions using the chat box, which you find on the bottom right-hand side of your screen. And finally, when you exit this webinar, you'll see a prompt for our event survey. Please take a few moments to fill it out. Your feedback is very important to us and helps us continue to improve our programming. And now I'd like to introduce our moderator for today's session, Jason Stewart, who's an executive in residence here at the Global Risk Institute. Jason, over to you.
Thanks, Vanda. Good morning and welcome. Today's session is the second in GRI's 2024 macroeconomic webinar series. It will examine housing's numerous challenges for Canada's economic environment this year and the resulting risks and opportunities. Housing is unique in multiple ways for Canada's economy. It is both an essential service in providing shelter and the most valuable financial asset for the large majority of Canadians. Housing is crucial to economic growth but can create financial stability risks when booms occur. It provokes intense debates between those who see inadequate supply as the cause of housing's affordability problems versus others who cite excess demand. Today's webinar will begin with a presentation and prepared remarks from our speaker, Robert Kapsik. We will then move to the Q&A component with Rob that I will moderate. I'm pleased now to briefly introduce our speaker, Rob Kapsik, who is back for a second year to discuss the housing market. Rob is Senior Economist and Director with BMO Capital Markets. He has been with the bank since 2006. Rob plays a key role in analyzing economic, fiscal, and real estate trends in Canada. His balanced analysis has offered leading insights and perspective on housing for many years now. Recent examples include, in early 2021, Rob accurately predicted that ultra-easy policy would add an enormous boost to existing price pressures that year from Canada's demographic trends and housing supply constraints. In May 2022, Rob forecast an extensive housing correction that year, given excess demand and undue buyer expectations, rather than an imbalance in the fundamentals of supply and demand. And last February, in GRI's housing webinar, Rob set out why prices and sales would falter in 2023, why the housing industry was at capacity, and why government supply targets were unlikely to be met. Rob's analysis is especially timely in early 2024. With thanks again for joining us, Rob, please begin your formal remarks.
Thank you, James, for that introduction, and thanks everyone for coming on the call. So you laid out a pretty good history of where we've been really quickly on the housing market front, and I'll just say that with that in mind, I think 2024 is going to be a year where we see another step towards transition, in the sense that we're at a turning point in the monetary policy cycle, and we're probably at a point where that tough and drawn out real estate correction does start to find a floor as we get through the spring and into the summer. So I'll very quickly go over our base economic outlook, what we see for inflation and interest rates. That kind of sets the backdrop for the real estate market, and then drill into a few issues like what we're seeing on the demand side and on the supply side, how those are balancing out, and then in a couple different ways to look at housing valuations and maybe where we are with respect to this correction going forward. And then, of course, there's time for Q&A after. So first of all, just to set the stage here, our economic outlook it's not out of line with what you have seen from the consensus forecasting community out there, right? So we're effectively looking for very little economic growth in real terms in Canada through the spring of this year. So, zero growth in Q4, zero growth in Q1, and then kind of picking up to a low 1% run rate through the second half of this year. So a pretty tough environment here. We have not seen an outright recession in Canada, and there are a number of reasons behind that. Just, household savings acting as a cushion, a lot of excess demand for labor. Also, the reality that when the population is growing at 3% per year, that's a very significant real support for the economy. So yes, in per capita terms, I think we've all become aware that we're seeing pretty significant recession-like declines in per capita output in Canada. But in the aggregate, it is helping to support a lot of the economic numbers, like consumer spending and things like that. Why we're still a little bit subdued on the economic outlook, really, when you boil down a lot of these factors, it comes down to the fact that we've seen a generationally abrupt increase in interest rates, right? And as we all know, when the Bank of Canada raises rates today, you don't get the full impact of that flowing through the real economy until, let's say, 12 to 18 months down the road. Right in the peak of the Bank of Canada's tightening cycle was last summer. So that right now kind of puts us squarely in the middle of us absorbing the full impact of those past interest rate hikes right now and through the next 3 to 6 months or so. So that's kind of the backdrop where the economy continues to struggle. And I'll get to the interest rate outlook a little bit later on, but we see better conditions in the second half of 2024 and through 2025 as rates eventually do back off. Now in the job market very quickly, so I think one thing we're seeing very good evidence of here is that because there has been so much excess demand for labor out there in the economy, we have seen monetary tightening actually start to pull down that excess demand for labor, chip away a lot of that excess, and we're seeing a lot of those job vacancies and excess job openings come off. But we haven't gone so far yet as to create a lot of unemployment. So we don't see any net job loss on a month-to-month basis. We've seen some upward drift in the unemployment rate because the supply side has been very strong. And then when you look out over the course of the next year, we see, the Canadian unemployment rate peaking in the 6.5% to 7% range, plus or minus a few tenths. And that's probably something that the economy is going to feel a little bit, and certainly some pockets of the economy from a household perspective or an industry perspective are going to feel that. But it's not a significant textbook recession where we see double-digit or near double-digit unemployment that ultimately filters through and really puts more additional stress on the housing market. We don't think we're going that far. And then finally, on the inflation front, we have seen obviously pretty significant progress on inflation to this point. Our view all along on the inflation backdrop in Canada has been that getting from 8% back down to 4% was going to be very easy and it was going to be relatively quick, and it was. Our view all along has been as well that getting from 4% back down to 2% is going to be quite a bit tougher and it's going to take quite a bit more time. And unfortunately, we're still seeing evidence of that. So I have a checklist here, which I won't go through in the interest of time since we're focusing on housing here, but a checklist of a lot of the different components that have driven inflation in Canada and where we've made progress. And we're really kind of stuck on those last two issues where we are seeing that past tightness in the labor market still filtering through into strong wage growth, and psychology out there as well is still very inflationary. And I'll point to two things just within the last 48 hours. The inflation report this morning in Canada showed pretty stubborn and pretty sticky core inflation metrics, not only on a year-over-year basis, but in the last 3 and 6 months period. The Bank of Canada's core measures are still running pretty sticky. And in the bank's business outlook survey yesterday, one of the hawkish takeaways of that survey, and there were dovish and there were hawkish signs within that as well, but one of the hawkish takeaways was that inflation expectations as well, especially in the business sector, are remaining pretty resilient. So with that in mind, I think we've got to the point where the Bank of Canada is close to cutting rates. I think as we speak right now, the market is pricing in a full rate cut by April and about 125 to 150 basis points of rate cuts over the course of 2024. We are expecting the bank to cut rates. I would just caution that maybe the market got a little bit ahead of itself, pricing in rate cuts a little bit too soon and maybe a little bit too much for 2024. So our forecast for the Bank of Canada is here, and their interest rate complex overall. We're looking for the bank to start cutting rates in June. and cutting rates by 100 basis points over the course of 2024, another 100 basis points in 2025, and then getting back down to what we believe is a neutral rate of 275 in 2026. So pretty gradual process to not only start the easing cycle, but also as we go through the easing cycle, under the backdrop that the economy holds up relatively well. We don't tip into a full-scale recession that would prompt much more aggressive rate cuts, but also the reality that we still do have sticky core inflation and pretty resilient inflation expectations across a lot of the different surveys in Canada. So 3 big takeaways here. Number 1, the tightening cycle is over. I think we're well past that. We all understand that. Number 2 is that rate cuts are in view in 2024, but they might be a little bit later and a little bit less aggressive than the market has priced now. That's not to say we don't think the bank is going to cut this year. We think they will. But then number 3, and this is an important one, when we come out the other side of this cycle, or we find a low for interest rates in this cycle, question we got to ask is, are we going to go back to levels that we saw during the pandemic? We're going to go back to levels that we saw during the post-financial crisis, 2010 through 2019. And I would argue that we're probably not going to find those levels. So the neutral level for interest rates right now would be quite a bit higher. And as an example, I mean, look at where Bank of Canada policy was 2010 through 2019 pre-COVID. Average was about 1%. We suspect neutral now, as I said, is about 275. So bring it back to the real estate market and the real world. What does that mean? Well, if you got used to mortgage rates in that 1.5–2% range, or if you're expecting mortgage rates to very quickly go back to that level, I think you're going to be disappointed. You probably want to budget something like 3.5 to 4.5% as neutral for mortgage rates in Canada going forward over the next cycle or two. And yes, 5.5% borrowing costs that we have today are very restrictive. There's no doubt about that. That's by design, obviously. Point being that coming down the other side of this interest rate mountain, we're probably not going to go back to levels that we got a little bit spoiled with over the last, not only the last 2 or 3 years, but also over the last decade. So that's the big economic, inflation, and interest rate picture. We'll zoom into real estate now, and we'll start by just kind of laying out our big picture forecast for Canadian housing in 2024. And we'll say 3 things. First, on the sales volume side, volumes have been pretty depressed, obviously, with interest rates very restrictive. I think we'll probably start to see a low in volumes set this winter, and we get some more real estate volume momentum coming out of the winter into the spring and into the summer. I think realistically, there's just quite a bit of pent-up demand that has been kind of pushed onto the sideline that's still waiting to actually acquire property in this country. The market has just really not been able to clear because there's been a big imbalance between what sellers think they should be getting, for example, prices that existed 12 to 18 months ago, and what buyers can actually physically afford or qualify for at the bank under current OSFI rules. So there's been a very big bid-ask spread in the real estate market, so to speak, that's been really depressing volumes. But I think a couple of things are going to happen as we talked about. Interest rates come down, prices have come down. That improves the affordability calculation. And at the same time, I mean, there probably are sellers out there that have waited 1.5 years or 2 to not turn their property over. Maybe we kind of reach the point where we do see some sellers actually take these lower prices. So I think better volumes are in store. For prices, we're looking at a bottom this spring and pretty modest momentum through the second half of the year and through 2025. I'll get to housing valuations a little later on in the presentation, but I think the reality that we do have that pent-up demand and we are looking at some mortgage rate relief is probably going to set a floor in prices overall in the Canadian market this spring. And then on the supply side, again, I think last year our forecast, which was a very contrarian forecast, was that housing starts were actually going to fall in 2023, despite all the very aggressive provincial and federal supply targets. That actually proved to be right. I don't think starts are going to face a lot of downward pressure this year, but there's certainly not a whole lot of scope for new supply to increase, just given that the industry is at full capacity right now. So look for a continued robust level of new housing construction, but certainly still well below federal and provincial supply targets. So that's the big picture. Drill into a couple of things then and look at the demand and the supply side. So a little bit of a background on this. I think for the last couple of years, there's been a big debate out there in economic circles and in the media circles about what the real issue is in Canada and why affordability has become so stretched. And the consensus wisdom has been that we have a supply shortage and that we're not building enough. And I think our view, and for a while it was kind of the lone view out there, has been that no, we have a supply situation that is doing all it can. What we really have is a problem of excess demand. And I think to really simplify this, in the interest of time, I think you can say that excess demand has come from two areas. First one was during that pandemic asset price boom, when the Bank of Canada cut interest rates to zero, promised Canadians they were going to leave them there for a long time and effectively encourage them to go out and borrow and buy real estate in an environment where prices were already running. It kind of just snowballed and exacerbated this speculative run, this fear of missing out in Canadian real estate. And visually, you can see that on the left side of the screen, where we had a complete blow off to the upside in residential sales activity in Canada, well beyond anything we've seen over the last decade or so. So that was pretty clear excess demand in the real estate market in Canada that was stretching valuations. Now, not a surprise, the minute the Bank of Canada first raised interest rates this cycle, even off the zero floor, the housing market went dead almost overnight. And so that was a very clear indication that there was a psychological aspect playing out in the market that was broken very, very quickly by tighter monetary policy. And so as that has played out, we've seen sales activity obviously come back down, and we've seen the asset price correct across various markets in Canada, obviously depending on the amount of froth in each individual market, but we have seen prices come down 20 or 30% in various markets across the country. So that's one aspect of the excess demand situation that was very quickly corrected, as we expected. The other side of it is on the demographic front. And demographic support, we know in Canada, is very strong. It has been for a long time, and it's one of the reasons we've been housing bulls for a long time in Canada, going back to last decade. International immigration targets, permanent resident targets, we know what those are, about 500,000 per year. Those are obviously critical for our long-term labor supply in Canada. Those are robust targets that we are just able to meet on the supply side. We have a millennial group in Canada, the peak of which is about 32 or 33 years old right now. And as I always say, what happens when you get into your late 20s and your low 30s, you graduate, you move out, you take a higher paying job, and you start having your first, your second, or bless my wife, your third kid. And when you start having 2 or 3 kids, you're looking for houses with space. So that is also pushing up the demand curve for housing in Canada, and that's peaking right about now. And then the third piece of this is you go on and you throw another 700,000 or 800,000 non-permanent residents into the mix. And very quickly overnight, you go from a run rate of population growth that the construction industry has just been able to satisfy. This goes back 2016 through the early stages of the pandemic, to now 1.2 to 1.3 million new Canadians per year that no market is ever going to be able to supply, regardless of what we do on the policy front. That is just an extremely acute demand shock that we pretty clearly can't supply. And the escape valve for that imbalance has very clearly been partly on home prices themselves, but more dramatically on the rent side. And we're seeing rents obviously a major contributor to Canadian inflation right now because of that. So those are two big demand shocks there. The first one, just exceptionally cheap money, which the Bank of Canada has now taken away, but also very robust immigration targets, magnified by extreme non-permanent resident flows. And we are seeing more hawkish commentary out there from federal policymakers right now. So I would say one thing to keep an eye on in 2024 is if this sudden discovery that we have a demand side problem on the immigration front actually translates into some more hawkish policy measures. Does that dampen down the demand for rental property in Canada and then take some momentum out of rents? We're not seeing it yet, but it's certainly something to keep an eye on in over the course of 2024. Now, on the other side of the demographic front, so people move into Canada, obviously they age within Canada, but they also move within the country itself. And right now we're seeing some pretty significant migration flows province to province. So right now about 50,000 people are leaving Ontario and effectively moving anywhere else, for the most part to Alberta and to Atlantic Canada. So what's interesting here is that historically, Alberta has experienced periods where we've had exceptional interprovincial migration inflows, and we've had periods where people were moving out the other way. What's different this time is that historically people would typically move to find a job if they didn't have one, or to find a higher paying job if they already did. So think of somebody flying into Fort McMurray from Atlantic, Canada, for example, to take a job when unemployment rates were high in Atlantic, Canada. Now what's different is that labor markets are very tight across the country, so that's not the differentiating factor anymore. The differentiating factor now is affordability. And one of the big reasons we're seeing movement outside the core of the GTA and Ontario more broadly into a market like Alberta is to pick up the affordability trade. And we hear anecdotes of this all the time where somebody can sell a property in Ontario, bank $1 million of equity, move to Alberta, and live a beautiful life at a much more affordable rate, not only housing, but taxes and the whole spectrum. And different working conditions that we now have post-pandemic have allowed that trade to happen. So we're seeing that in mass, where about 50,000 people are pouring into Alberta right now from other areas of the country, and that is really driving a wedge in housing market performance between the different regions, where we're not seeing much of a correction in a market like Calgary at all. Now, in the bigger context, the last thing I'll say, I bring up this story because it's interesting and it's reflective of different affordability conditions across the country. But at the end of the day, if you look at the contribution that provincial migration flows are making to the overall population picture, it's significant in Alberta. But in Ontario, as bad as it might sound to be losing 50,000 people per year, it's only 0.3 of a percentage point being carved off of population growth. International immigration is adding 3.5 percentage points to Ontario right now. It is dwarfing by magnitudes the outflows that we're seeing to other provinces. So at the end of the day, this is still a very, very robust and stressful demographic situation from the demand side across really all of Canada right now. So some thoughts there on the demand side. On the supply side, I think the minute budget 22, I believe it was, came out with very aggressive supply targets. As noble as those supply targets are, our response from day one has been, sounds great, but we're never actually going to be able to build as many homes as policymakers think we need to balance the market out. Simply because, look, we and me personally talk to a lot of home builders across the country through our commercial bank, and it's unanimous that the industry is operating at full capacity, right? Vacancies have been extremely high, unemployment has been extremely low. We have a shortage of skilled trades, and the industry at 240 to 260,000 new housing starts per year is running all out. And so to think that we can double or triple that rate of output overnight to meet what we're seeing on the demand side, it's kind of pie in the sky. And the proof is on the ground where housing starts just aren't getting much more traction than they already have. So that's where we are on the supply side. I think certainly any kind of policy measures that make supply more responsive and get ground broken more quickly and get projects completed more quickly, things like development charges or the approval process or productivity in the housing sector is terrific, right? If we make the supply curve more elastic, more responsive, that's terrific. But increasing the actual number of units has proven to be very, very difficult in Canada. So while the goals are noble, I continue to believe that these are not actually the solutions to our housing crisis in Canada. So that's a bit of a fundamental backdrop. We'll look a little bit here at housing valuations and prices and where we think we're going on that front, and then leave some time for Q&A. So I mentioned that we do believe that housing is going to bottom out in the first half of this year. And so I'll look at 3 different ways that we fundamentally assess housing valuations in Canada. And you get a pretty good picture here, but because these different measures show us just how frothy the market got, but also kind of lead us toward a conclusion that the market is pretty close to finding a floor. So the first one is just based on long run economic fundamentals. And this is, I know this is a pretty busy chart to look at, but it's really not that complicated. So on the left side of the screen, you have real inflation adjusted house prices in Canada going back to 1980. The blue line is the underlying long-term run rate of about 3% per year. That's historically what we've seen. The middle panel of this chart is the difference between those two. So what's happening on the ground versus that long-term run rate. And you can see very clearly that we had a housing bubble in the 1980s. The early 2000s, everyone kind of forgets that housing was exceptionally cheap in Canada. Most of the last 10 or 15 years then, post-financial crisis, we saw housing rising about in line with the pace that it should have been. And then at the height of the pandemic boom, when real interest rates were cut deeply negative, we had another blow off in the price of the asset that we call housing. So right now we've kind of been going through a process of cleaning up the froth, and we do and have always believed that the supply and demand fundamentals in this country are still very sound and very strong. The mortgage lending practices in the country are very strong and very sound and leading to a resilient housing market. This is just the case where we need to clean up froth that built up during that pandemic episode. And real estate is not alone. We've seen it in the bond market. We've seen it in the equity market. Real estate is another asset class that just got well ahead of itself from a valuation perspective. So then what's interesting is we take that peak level of froth, and then the third panel on this chart breaks it down by region, and you can start to see that there were some regions like Alberta, for example, that we talked about, never really got all that frothy, and from a fundamental perspective, looks pretty reasonably valued at this point. Where a lot of the froth built up was in Ontario, the GTA, to a lesser extent, Quebec and Atlantic Canada, but more dramatically so in the exurb markets 1 to 3 hours outside the core of the big cities and recreational property as well. So we think that is where the adjustment is still running its course most significantly. But interestingly enough, when you push this forward to today, what we start to see across a lot of markets is that we have started to find balance again. And this has come from not only nominal house prices coming down, but also solid underlying inflation trends have also helped to rebalance this real home price balance in Canada. So that's one area that argues for the market being pretty close to finding a floor from a fundamental perspective. Another perspective we can look at here is from the perspective of a household. So what does it cost to actually go out there and buy a house? And from that perspective, affordability is still extremely poor. Okay, we all know that. This is the Bank of Canada's affordability index, or let's call it an unaffordability index, where we're sitting right now. We have a similar model that we run in-house that looks very similar to this. The main takeaway being that housing is as unaffordable as it has been since the late 1980s. And now, so we push this forward and say, okay, given our forecast for 2024, is this going to improve? I think it's going to improve, but it's not going to improve a lot to get us to the point where housing is suddenly affordable again. So you can do a quick simulation on this and say, okay, if we look at our interest rate forecast, and let's assume about 100 to 150 basis points of mortgage rate relief. So say over the course of this year, the bank cuts rates and fixed rates continue to edge down. That alone right there would close about half of that unaffordability gap from where we are now to where we were in that pre-pandemic normal range. So it takes us about halfway there, but not all the way there. We can also assume that given what we're seeing in the job market, that wages continue to run at a historically strong pace. That gradually helps close the affordability gap as well. And then the final piece of the puzzle is obviously the price of houses themselves. And this would argue for some more downside pressure on home prices as we go forward over the next year or two. So the way we would kind of balance all of these things out is say that, yes, interest rates are going to come down, incomes are going to continue to climb. We probably have a little bit more downside risk for house prices, and then they kind of level off and kind of stagnate for a while going forward as this affordability balance reestablishes itself. And so that's where we are from that fundamental perspective. And then the third way we can look at this is, okay, look at this from the perspective of an investor. An investor at the height of the housing boom coming out of the pandemic was looking at cap rates, so net income on an investment property, in that 3 to 3.5% range, which was extremely tight by historical standards. But when risk-free interest rates were at historic lows and prices were running at 20 or 30% per year, maybe it made sense to take on a property from a cash flow perspective or from just the perspective of expecting price gains. But so now very quickly, this dynamic has shifted because we've gone from 1.5% borrowing costs to, let's say, 5.5% borrowing costs. From a cash flow perspective, investment at a 3.5% cap rate when you have risk-free money at 5% and borrowing costs a little bit higher than that obviously doesn't make sense anymore. So we're watching cap rates in the residential market or the multifamily market, or in the condo market, get pressured up to reestablish a more historically reasonable relationship with long-term GOC yields. And so given where we expect Government of Canada yields to settle here, and as I mentioned earlier, it's going to be higher than we've seen in the last 10 or 15 years, that would argue for cap rates to drift up and settle in somewhere in that 5 to 6% range, obviously depending a little bit on the asset class itself and the neighborhood itself. But generally, that's roughly the range we're looking at. And so we have seen those cap rates back up already. We're not quite there yet, but we've seen, just given prices are down 20 or 30% across some segments, that and rent growth continues to run at a double-digit pace, those cap rates are getting pretty close to reestablishing themselves at a level that is more consistent with long-term government yields. So again, the takeaway from the valuation perspective here is that you can wrap all this up and say we're not quite there yet, but you can see an environment in 2024 where house prices have come down enough and these underlying economic fundamentals do kind of assert themselves to set a floor for Canadian house prices. Are we going to go back to the kind of exuberant days of double-digit price growth and rampant demand? Probably not under the economic conditions that we're looking for playing out over the course of this year. But I do think it's going to be a year where we start to see and start to feel the market change quite a bit. So I will leave it at that. James, if there are any questions, happy to take them at this point.
Excellent. Thanks very much, Rob. We'll now turn to the Q&A portion of the webinar. A reminder, if anyone has a question, we invite you to type it into the chat box in the bottom right of your screen. Be sure to choose all panelists when you do so. To start the Q&A, traditionally economists and analysts have put greater weight on employment trends and unemployment rates relative to interest rates in assessing future housing demand and prices. Is this still the case given current mortgage costs and the interest rate sensitivity of current and potential homeowners in 2024 and beyond?
Yeah, so I think interest rate sensitivity is a big issue here for sure. And it's one of the reasons why we are still pretty subdued on our economic outlook at this point. Is that the Canadian household, going back over the last 10 or 15 years, pretty clearly levered up a lot, right? We all know that. At a time when the US household as a comparative was deleveraging, the Canadian household was leveraging up. And we also have the mechanics of our mortgage market that are quite a bit different here. We know we're going through and right in the middle of this wave of mortgage renewals right now, where Canadians are coming off very low fixed rate mortgages from 5 years ago, or 2 or 3 year fixed rate mortgages from earlier in the pandemic that are rolling now into rates that are in the 5 to 6% range. So there's a pretty significant adjustment, I'll say, coming there. So I would not say this is something that's going to totally break the real estate market, create a lot of delinquency and foreclosure, create a lot of severe economic consequences, but it is draining discretionary consumer spending quite a bit, because we know Canadian households are going to pay their mortgage first, and we know banks are working with households to adjust amortizations and things like that. But the reality is there is quite a bit of rate sensitivity in the economy, embedded just as a share of the economy, and we're dealing with a very significant interest rate shock right at this time. So policymakers have to understand that and respond to that. And from a macroeconomic perspective, I think the way you see this play out, first and foremost, is on the discretionary side. So less travel, less discretionary consumer spending. We're seeing that very clearly already in things like the retail spending numbers, where retail spending volumes are pretty flat. But when you consider the population is growing at 3%, every individual household in Canada is spending less in real terms on a per capita basis. So you're seeing pretty clear evidence that rate sensitivity is biting a bit here.
Thanks, Rob. Looking at Canada's house price and sales activity trends from a global perspective, other countries such as the UK, Australia, and New Zealand are also facing major price pressures and large demand supply gaps. How would you compare housing market trends in Canada in recent years relative to housing markets in these countries and other advanced economies?
Yeah, so that's a good question. I think in recent years, you have to be respectful or be mindful of the fact that we went through a pandemic, and a lot of countries faced very similar shifts to what we saw in Canada, where so even in the US, a lot of the factors that shifted around in the housing market played out in Canada as they did across the globe. So moving out of the big cities to the suburbs, finding more space, things like that, changes in the way we work, hybrid in Canada and the US as well, pushing some more activity into the smaller centers. We've seen that in Canada as well. So that's one area that is kind of an acute issue, but from a bigger picture issue, I have a chart here that I can throw up that lays out pretty clearly. If you go back to the late 1990s, I don't know if I can have access to this chart, but
The chart will come up.
oh yeah, there's a good chart. You mentioned Australia, you mentioned New Zealand, you mentioned Canada as having some of the strongest run rates for real house price growth in the developed world. And it's a pretty simple story here when you look at real house price growth versus population growth, right? Population growth is a demand side factor that ultimately drives house price growth after inflation over a long period of time. And you do a quick cross-sectional look at how population and house price growth trends have compared across the developed world since the late 1990s. It's pretty clear that one of the reasons Canada has some of the most robust house price growth is because they also have some of the most robust population growth. And I mean, I don't have to spend really a lot more time explaining this chart. It's very, very clear here. There are some other issues that maybe have an impact around the edges. So a country like New Zealand obviously is very space constrained. Canada is not space constrained from a geographic perspective. Obviously, we're a big open country, but from a development perspective, we are constrained as well, where the vast majority of building activity is centered around 3 or 4 of the major cities. Even in an area like Toronto, where we have land, we've been constrained by the Greenbelt since the Places to Grow Act that Ontario brought in back in 2006. So that kind of just takes this demand side factor and maybe just exaggerates it a little bit based on some of the policy we've seen with intensification and development on the supply side. But at the end of the day, I mean, if you're growing the population at 3.5% per year, you're going to have a lot of upward pressure on house price growth. That's the evidence historically within Canada. It's also the evidence when you look across a panel of different developed countries. It's pretty clear.
Turning to questions from attendees, the first one notes that current construction industry is acting at capacity, but the future is modular and panelized, which are factory built and easy to ramp up. What's your assessment of the construction industry's adaptation to these modular and panelized opportunities that are factory built? And have you done any research into this method of building?
So frankly, no, that's a little bit outside my area of expertise. It's a little micro for me, but we do see a couple of things. We've seen a transition from, single family building through the 80s and 90s to more multifamily building. Part of it has been by rule because as I mentioned, since 2006 in Ontario, at least in the GTA, by rule, we've been constraining more of our development into the developed area already. So that's been driving more intensification and more of a shift towards things like townhouses and condos, which obviously you can not necessarily get projects built faster. One of the reasons we have more delays in construction is it takes longer to build a 200 unit building than it does a single family home. But on completion, you have a lot more units out there. So I think one of the things that this question kind of brings up going forward is that, yeah, there's a case to be made that we need to find ways to be more productive in housing on the supply side and make supply more responsive. And I mentioned this during the presentation where we don't disagree that we want to build more or that we should build more. We're realistic in the fact that we argue we can't build anymore. So when you look out over the next decade, yeah, anything that drives more productivity and makes the supply side more responsive is definitely great. And if the industry finds it economical to go that route, I'm sure they will do so.
Next question. Although an interest rate cut can improve affordability, do you think it will drive property prices back up and over time net off the effect of the rate cut on affordability or rate cuts?
It's possible. So I think what we saw very clearly early in the pandemic is when we cut rates to zero and promised to keep them there, you had a lot of price growth build into the market that went beyond what fundamentals would suggest, right? So that is like by definition froth. House prices in Canada over time typically get driven by income and interest rates, right? On a per capita basis. So the run up that we saw in prices went beyond the increases in income that we saw and the declines in interest rates. So that was froth. That's been partly cleaned out right now, but from an affordability perspective, you don't see it yet because those rates are still high. I suspect as we come out the next cycle that once it's confirmed that the Bank of Canada is cutting rates and we start to see that, and the bond market's already picking that up because 5-year mortgage costs have come down, right? That's helping affordability incrementally. It's just going to take some time to scrub out a lot of that froth that we've seen. So it's not going to be an overnight return to affordability. And to the point of the question here, is there a possibility that the Bank of Canada cuts rates and the market kind of heats up again because everyone thinks prices are going to rise again? It's possible, and I think it's one area that the Bank of Canada is going to have to be very mindful of, triggering another episode where the market starts to accelerate because there are inflationary consequences to that as well. I don't think we're going to get the same kind of run in house prices this time around, to be honest, but it's certainly a possibility that the Bank of Canada is going to be looking at.
Thank you. The next question, as baby boomers age out of their multi-room homes, how might that impact supply-demand dynamics and net population growth?
It's not happening. I think this is something we've been asked about quite a bit going back over the last 10 or 15 years. Baby boomers are going to retire. They're going to move into condos and townhouses and downsize and open up a lot of supply for the millennial group. It's not happening. Baby boomers, if the bulk of that cohort is 65 right now, let's be honest, you probably have another 10 or 20 years where they're not moving. And unfortunately, we are at a point where you have these two extremely large cohorts, one of which has all of the housing supply that the next cohort, the millennials, need, but we're not unlocking that supply because those boomers are not leaving, and they need a very compelling reason to leave a property that they, grew up in and raised a family in just for the sake of moving. And anecdotally, we don't see it in the numbers. We actually don't see a whole lot of it as either as you go through the life cycle. So I think it's a bit of it's not a myth. It's something that's just probably not going to happen.
Next question relates to property taxes, and it both is relevant for your current response in terms of incentives for baby boomers to stay in place, given the size of the property taxes, given municipalities have limited options for revenue raising, but also just on the impact generally in terms of supply. And then specifically, are you seeing differences in major municipalities versus the surrounding suburbs, exurbs, because of property tax differentials?
I don't know. Like, so at the margin, I mean, theoretically, you can argue that yes, it's probably something that just gets built into the cost of living, right, in your affordability calculation. I don't know if it's the biggest driver here, right? So the biggest driver in some of these exurban markets, so somewhere like a market outside the core of Toronto, which does not have an extra land transfer tax stamped on it, for example. Those markets have been exceptionally strong. I don't think property taxes themselves have been the big differentiator. Really, at the end of the day, it comes down to affordability because, your monthly carrying costs or your overall cost of carrying that house, property taxes, the differential in property taxes might be relatively small in the big picture. And ultimately, if you're a young family looking for space, I mean, you're going to go wherever you got to go to find that space within your budget. And in the big picture of that budget, I think property taxes are still relatively small. To your point, I mean, on the boomer cohort, I mean, yeah, it's especially as you get into like fixed income years and things like that. If you have a very high tax jurisdiction, it could start to crowd some of that cohort out. But this is a much longer term issue we don't see a whole lot of right now.
Thank you. Turning to the financial institutions side, do you think that financial institutions have appropriately accounted for housing market risk in terms of delinquencies, credit loss provisions generally? You can feel free to take this into OSFI's stress test impacts if you desire as well.
Yeah, so I'll say I don't have a lot of perspective from the financial institution side, right? So I won't comment on that. I think from a macro perspective, I'll say that we have a very good track record in this country, right? Of of running the economy and going through cycles, and some really tough cycles from a real estate perspective, with very well contained delinquency rates. And this kind of speaks to just the much more conservative nature of our lending standards in Canada, and the much stronger regulatory regime that we have in Canada, and other, I mean, technical factors, like we have full recourse on lending across most of this country. So that's a big differentiator versus what we saw in the US, for example, in 2008, 2009, where households were just leaving keys in the mailbox, right? We don't have that in Canada, right? And I mean, to your question on OSFI, look at what we've done over the last decade. We've seen a steady stream of tightening the screws on mortgage lending standards in Canada, to the point now where when you walked into the bank in 2001 at the height of housing froth, and you were borrowing at 1.5%, you were probably still qualifying at 5.25. And at the time, I remember a lot of people were asking the question, well, why are we qualifying at such a ridiculous rate when mortgage costs are 1.5%? Well, it's a good thing that we did, because a lot of those mortgages are rolling into rates that they fortunately have been stress tested at.
Mhm.
So I think there's a lot of resilience built up into the mortgage market, and it's kind of goes back to what I said earlier, where there is going to be some fallout from this, but I think it falls more on the discretionary spending side rather than on a wave of delinquencies that really has a big impact on the real estate market. Now that said, I mean, there was a big investor class at the height of the boom that maybe bought, a lot of pre-construction inventory and stuff like that, that never had the intention of closing. We're seeing some stress in that area of the market now, and I suspect that as a lot of that comes to completion, we're going to get that flipped onto the resale market, and there will be pockets of investors that do get hit pretty hard, but it's not a widespread economic issue at this point, I don't think, no.
Rob, that leads well into the next question. You started with individual investors, but looking at the situation for real estate as an asset class, and you got into this with the cap rates on one of your slides and your discussion. How do you see the prospects for real estate as an asset class, both for individual investors as well as obviously larger FIs and financial institutions, in the context of performance after the struggles, for example, in commercial real estate and some of the others we've seen in the last couple of years?
Sure. So I'll start by saying this. When we talk about investment, uh, a lot of times people hear that and think of it as a bad word, right? Real estate investment is a bad word. It's not a bad word, right? Investors they play a very important role in the economy, in the sense that they bring rental supply to the market. And rental supply, as we know, is very, very much needed right now. And a lot of the rental supply we have in Canada now is not from purpose-built sources like it was through the 70s and the 80s. It's from individual investors that have invested in things like condo and townhouse projects, and have used that to flip onto the rental market. That from a fundamental perspective is good. It's good cash flow driven investment that serves a need for Canadians, right? Through the pandemic, when we cut rates to zero and we had that period of froth, investment kind of morphed from that into something that looked a lot more speculative, right? Investment wasn't driven by cash flow and rent fundamentals anymore. It was driven by expectations of price gains, and it was driven by, as we just talked about, maybe people buying 3 or 4 pre-con projects and never having the intention of closing on those, or renting them out to a renter that needed a place to live. So what I think we end up with here is, as higher interest rates clean the froth out of this market and we reestablish ourselves, maybe this year, maybe 2025 and beyond, where fundamental cash flow driven investment that provides a service to Canadians, rental stock, reasserts itself and that is what the asset class becomes, rather than just this speculative expectation that I can buy something and change the floors and flip it for 30% more next year, or I can buy a pre-con project and flip it to somebody with no intention of closing, right? I think that's where we're going, and higher interest rates are doing that.
Picking up on this theme, another attendee asked, in the context of recent headlines about various condo projects going bankrupt mid-build in Toronto recently, do you see these as outliers or the beginning of a trend of new starts coming under more pressure prior to completion?
Yeah, I think it's a symptom of where we are in the cycle, and as we've said all along, and one of the reasons we expected new construction activity to actually fall this year, last year, sorry, 2023, was that market conditions are such that they're just putting a lot more stress on the market and on builders, right? And this is a symptom of the tightening cycle, which was very aggressive, and it was very aggressive across a lot of the developed world, partly because monetary policy was just left too easy for too long. So it's kind of a consequence of that. So I don't think it's a one-off. I think it's pretty reflective of the reality that borrowing costs are up, and overall market conditions have just deteriorated quite a bit. So I think that does stick with us for a little bit, and that's again another reason why we are kind of pushing capacity constraints here, because the industry can't do a whole lot more than it already is, especially when we have now suddenly much more challenging economic conditions too.
Picking up on the last question, but also on some of the others with respect to exposure, when you look at the risks of financial institutions generally and the gamut of mortgage lenders, from the large banks through credit unions right to the mortgage investment corporations, what's your perspective on the risks generally, given the housing outlook that you have?
Generally, from an economic perspective, I mean, so I'm not going to comment on financial institutions themselves, but I think we've touched on this from an economic perspective, where you see a couple things in this environment. You see credit conditions tighten up, of course, right? Not just the price of credit, but the availability of credit for maybe some of these weaker alternative lenders or financial institutions that don't have the capacity to lend at this point like they would have when conditions were a lot more favorable. So that tightens up credit overall for the real estate market and the economy. You're seeing credit growth numbers slow pretty clearly across the board in Canada. But then more specifically, and I think this is a theme we've touched on a couple of times right now, where households are in pretty decent shape overall from an asset perspective or from a liquidity perspective, right? We have probably 10 to 12% of GDP of excess savings stocked up on the household balance sheet coming out of the pandemic, and a job market that is still very resilient. And so if our forecast is right and we see the job market hold up relatively well, I'm not saying there's not going to be any uptick on unemployment, but if we see unemployment kind of cap out in that mid 6% range, I think that, combined with a lot of savings on the household balance sheet, are going to allow us to get through this without a lot of that stress spilling over into the broader macroeconomic environment.
Thank you. Housing share of Canada's GDP has risen significantly in recent years and jumped since the pandemic. From your perspective, should we be concerned about residential investment's role in Canada's GDP growth and productivity, or do you see this correcting itself over the next few years with potentially normal for longer nominal yields?
I think it's correcting itself. So residential investment it's an interesting component of GDP. So we would typically think of residential investment as building houses, right? But that's not the only component of residential investment. So residential investment would be building houses, it would be renovating existing houses, and there's value in that for sure. And it would also be the basically the resale transfer costs of activity in the resale housing market. So what we've seen really blow off to the upside was the latter component, resale housing market activity. That has come down very quickly, so that's normalized itself. We are still, of course, dedicating a lot of resources to constructing new homes and renovating existing homes. And is it a bad thing? I don't know. When you have, again, historically strong population growth, we need that, right? But that's one area where I suspect is probably going to show quite a bit more resilience, even if that latter component falls off pretty quickly, which it already has. So I think we kind of grow down the road of kind of normalizing housing share of the overall economy for sure, and the productivity issue is a whole other can of worms that that we probably don't have to open in this context.
Thanks very much. I apologize again. We have a lot of excellent questions coming up through the chat, but moving to our final question in the last few minutes of the webinar. Given the impact of monetary policy on housing demand over the past 2 decades, and especially in recent years, should the Bank of Canada put more weight on housing market and rental price trends in its future policy? Indeed, should the BOC and other central banks take greater account of asset markets generally in determining policy?
I think there's a role for it, right? So I think you don't want the Bank of Canada explicitly targeting the housing market, but there are a lot of times where if you see something that's creating a, a macroprudential or a macroeconomic risk down the road, I think you want to be mindful of that. Something like extreme excess froth in the market, which you know is going to have economic consequences down the road. I think you want to be mindful of that. Housing, I think, is also a good indicator for the Bank of Canada, even if they're not targeting house prices or housing activity per se. It does filter into economic growth and inflation, so there's that. But it's a good indicator for them when arguably the most interest rate sensitive sector of the economy starts to accelerate really quickly or decelerate really quickly. Maybe that's a sign that policy is too loose or too tight. So they can use that as an indicator for sure. And then there are other issues in housing that directly influence the Bank of Canada because they directly flow into the CPI, which effectively is the Bank of Canada's mandate, right? They're inflation targeting central bank. So things like extreme increases or decreases in house prices do directly flow into the CPI. Things like extreme increases in rent directly flow into the CPI. The mechanics of that are a bit tricky because sometimes some of those components lag a lot. So rent doesn't necessarily get reflected right away. It lags a lot, but it is an influence on inflation in Canada. And then mortgage interest costs, obviously, right now as well, playing a big impact. That's another component of the housing basket that's having a big influence on inflation, which is, of course, a direct consequence to the Bank of Canada. So it's it's not a clear yes or no for me. I think it would be kind of irresponsible to just ignore the asset markets altogether because they're sending pretty loud signals to the Bank of Canada, to policymakers, what's happening in the real economy, maybe, and what policy settings are relative to what the appropriate level is, right? 2021, 2022, it was obvious to us, at least, maybe not everybody, but it was obvious to us that policy was way too easy for way too long. And housing was one asset class that was yelling very loudly at the Bank of Canada that policy is too easy. So it's not a clear yes or no, but I think there's those are some thoughts at least on how the market does play a role and should play a role in the thinking, at least.
Rob, thanks. Vanda?
Great. Thank you very much. Thanks, Rob, for spending this time with us today. It was very insightful, and it was great to see. Being a parent of a millennial, I learned a lot of things here.